Hello there traders, welcome to the Commitment of Traders Club Fibonacci retracement lesson. My name is Lucas, founder and creator of the Commitment of Traders Club. I'm so glad that you've joined the club. Thank you very much for your subscription, and we hope you make good use of our trading tools and techniques to ensure that you beat the banks whenever you trade Forex. So let's get straight into the video with how to trade using the Fibonacci retracement tool. For those of you who don't know what one looks like, you may have come across it on TradingView before. That's the platform I'm using currently. I'll draw one out for you. At first glance it looks quite difficult to understand. Lots of different lines, lots of different numbers, but they will all come apparent when we look into the chart and also our basic drawing. So, as we know, market moves in two formations. We've got push up, the pull back, and then the push back up again, pull back, push back up. It moves in a wave formation. So it moves nice, pulls back, got the impulse back up to the upside, and then pulls back again. And ideally what we like to see is when the market makes the first impulse to the upside, we've got this area of resistance, it pushes down to the downside, finds some support, breaks through the previous resistance, tests that level for support, and up it goes to continue. And us as traders, we like to enter the market at the safest point to gain maximum pips and maximum profits in this instance. But the Fibonacci tool will assist us in understanding where the pullback will end so we can get better and cleaner entries when trading. So drawing it again, we've got our first push to the upside. Then the market retraces and comes for that pullback, and then continues for the impulse breaking past the previous level of resistance. My personal technique is I like to get a box tool and draw on the chart the anticipated support area where we would like the market to come back and retest. Okay. How does the Fibonacci tool work? What we do is we take it from the previous lower low and we draw it up to the current higher high, like this. Now the numbers will start to make a little bit more sense. What we like to see is we want to wait for the market to retrace, and as it comes back, hopefully to our anticipated area here of previous resistance, which will now turn to support, we will catch the market on the retracement, which will then push to the upside. Now we need to monitor the chart on the 4 hour as swing traders to see when the market is starting to lose momentum, when the market is starting to fizzle out. My best options for these are candlestick patterns and formations, wick rejections. The stochastic indicator is great to find out when the market has started to become overbought or undersold, and then we can start to gain that entry reason to push to the upside. Now with the Fibonacci, we want to make sure that the numbers here, the pullback comes within these numbers between the 0.5 and 0.786%. The golden, or the magic number as I like to call it, is a 0.618 percentage, which 8 or 9 times out of 10 the market will respect this magic number and come back on the retracement to this level for them to push to the upside. And if it does so, we're almost guaranteed that it will push up in the continuation that we want the market to move. We must always remember that the trend is our friend. We never trade against the trend as swing traders. Best way to find the overall trend, especially with what the institutions are doing, is to look at the bigger picture, the weekly and the monthly time frames. So I hope that makes sense on a small diagram basis. However, it's best to look at it on the live charts. What we will do is say that it works in reverse as well. So it works obviously in a downtrend, and I'll show you exactly how that works, just for any of those who are confused or need a little bit more guidance on this. So in a downtrend, we've got the push to the downside, the pull back to the upside, and then the push to the downside. And what we want to see is the previous level of resistance now turn support. Grab our Fibonacci tool. Again, we know the market is trending downwards. We're looking for those selling opportunities, and we're looking to get that entry at the retest of the previous level to maximize our profits, maximize our pip efficiency. So we take the Fibonacci tool from the previous retracement, so the lower high, and we draw it all the way down to the lower low. And now what we can see is the potential area for where the market will look to retrace. Obviously we can see that the previous support is here, and we would like to anticipate it to push back, but sometimes they can go slightly deeper, and that all depends on market structure and price action and just monitoring the market on a 4-hour basis. So the market will pull back, and we'll notice that it does break through the Fibonacci levels, and by monitoring it we'll be able to see when it has signs of rejecting these levels and then to push. So we'd like it to come back to the 0.618 ideally. We know that that's where the market likes to respect this level and push down. Alternatively, it can come to the previous resistance, which will now turn support, and push back down. But you know, if it does break through the previous level, that it is likely to hit the 0.618 and continue downwards. The banks like to use it. It is their structural level, and it works on most market conditions. Now if we move down onto the chart, we can see this in a much clearer detail. So we're looking at the daily chart, USD against the Swiss franc. I've marked on straight away where our likely area of resistance is. We can see that over the past couple of days, or I should say a couple of weeks, the market has respected this level intensely. A false breakout up here which then pushed back in, but we'll look at those on another day. To gain understanding of the actual market structure and which way the market is trending, you have to zoom it out and look at the weekly and the monthly time frames to see the exact trend of the market. Most retail traders will look at the hourly or the 15-minute time frame. It just doesn't work for swing trading. Okay, we'll need to look at the market in the bigger picture. The institutions and the banks, they trade on the bigger picture. They've got money to move, and they like to move it over weeks and months rather than over intraday periods. So it makes sense for our trading style. So if we push back to the weekly, okay, we can see here that again we are in a downtrending environment. The market was moving sideways for a good couple of months here. However, we can see at a higher high, push back down, broke the previous, so a lower low, a lower high, lower low, lower high, and now we're down here at our lower low. So what we can do is we can mark our lower low currently on the weekly, and as I say, we understand that the market is going to be pushing to the downside. Okay, so looking at the daily chart on the same pair, USD Swiss franc, this is the time frame that I personally use the Fibonacci tool on. It has the best results, the best accuracy, and you can really see what the market is doing with it. So how do we put it into play? Take a Fibonacci tool. What we like to do is we like to start the Fibonacci at the previous higher point. Okay, so we can see clearly that the previous lower high in this instance was this area here. I'll mark it out of a square. Okay, this is the last point where the market found resistance and then made the last impulse down. So we take the Fibonacci tool from the top down to the current lower low. Again, if the market does push further down, it may need to be adjusted slightly. This is the generic way that it works. Okay, so straight off the bat we can see the levels that we anticipate the market to respect. We can already see that the market has tried to respect the 0.382 zone with huge wick rejections twice, which is a good sign, but time will tell if it comes back to the 0.618, which is where we like to take our trades. We know we get the best accuracy and the best success rate out of it. Swing trading is all about patience. It's very rare that you'll enter the market immediately based on your analysis of the market. We know that we're ready to enter into this zone here or of a retest around this area. Okay, so let's see how the market plays out. So we can see huge price movement from the lower low here. We anticipate it to have a deeper pullback in this instance. There are still some buyers in the market who are not ready to give up the ghost and go for the sell. We're now anticipating that the market will reject this area and push down. It's the magic number. The market respects it generally and we do know that we're looking for the sell opportunity. The market is trending downwards. What do we do now? On the daily chart, it's hard to get a precise entry on the daily. What we do is we head to the 4 hour. Over on the 4 hour chart, we can really see our strategy coming into play. We're at that 618 zone. We're anticipating that this is where the market will end the pullback and continue with the impulse to the downside, along with the market trend to the downside on the weekly and the daily. So let's see how the market plays out. There's the first sign of the rejection. We now have a very slight area of resistance up here. Let's see what the next few candles do on the 4 hour. 4 hour is perfect. Head over to our trading strategy to understand why we like to monitor on the 4 hour. Okay, so we're finding here that the market is starting to slow down. Buyers are not so much in control as they were previously. If we look back here previously, we've had some huge impulses from the buyers pushing the price up. Now with these small candle bodies here and larger wicks, we can certainly see that the buyers are losing power, losing the impulse movement, and we can expect the market to push down. Trading is all about probabilities. We know that the market likes to respect this area and we're in a downtrend. So what we'll do is we'll have a short position order. Stop loss shouldn't be too tight. We don't want the market to go against us. Good area on the Fibonacci is just to have it above previous structure. Looking to the left slightly. Yeah. Always want to go for a 1 to 3 risk to reward. We can be wrong 7 out of 10 times and still be in profit. Okay, so we want to set our targets. Perhaps originally down for the first set of targets to the original area of support down here as our first set of targets. Now let's see how the market plays out. To monitor it, we'll go back on the daily. That's where we'll be looking at it and watch how the market moves in our favour. Over a good fortnight or so, we've hit our 1 to 3, or excuse me, nearly 1 to 4 risk to reward. Profited 230 pips out of that move by understanding that the market likes to respect the Fibonacci levels. It's where the banks and the institutions trade from. The 0.618 zone, highly respected, in line with our current market trend. Competent traders looking at different ways to understand when the market is fizzled out. Head over to our strategy, become a platinum member, and look at our weekly analysis to find out when the market is fizzling out. As we can see there, huge smashing result, outstanding profits, very small risk. Jobs are good. Well, traders, thank you for checking out the Fibonacci trading lesson. I hope it's been of use. If you have any questions, platinum members, please feel free to drop me an email. I'm here to help you to grow your trading plans and educate you further on the market. Happy trading, stay safe, stay competent.